Good afternoon, everybody, and welcome to this week's macroeconomics analysis session for February 19th, 2016. DMAC here, and sitting alongside me this afternoon is Jeff Saffer. How are you, Jeff?
Good, thanks, David. Hello, everybody.
All right, let's get underway, Jeff. Can you do me the honours and click the mouse, please? Well done. The disclaimer first and foremost, the content of today's presentation or any other Elite Wealth material does not constitute a recommendation, nor does it take into account your investment objectives, your financial situation or particular needs. So as always, before making an investing decision, based on the general advice that we provide in any of our presentations, please consider whether the advice is appropriate in light of your financial circumstances or seek further advice on its appropriateness. Been a very interesting week this week, Jeff. A big rebound in the markets around the globe. Today, perhaps not quite so much. Overnight, a little bit of a sell-off in the US market in particular. The market's not yet closed, but our market looked to be a little bit down, probably about 20 minutes or so ago.
Yeah, so we were discussing that it's been a very nice week for the Aussie market and in particular overseas markets. Europe has been very, very strong. The US, very strong. Asia, fairly solid. And gains across most sectors in Australia. So I think leading up to this week, everyone has been very bearish. Obviously, the markets have fallen very heavily. We've seen a bit of a rebound this week. So does that mean that all the fears are out the window? Do you start buying again, or are we stuck in something worse? So we thought we'd make that the topic this week.
And I think just on that, Jeff, I remember last Friday when we were talking, oil was having a bit of a pop at the time in the afternoon, and we had quite a big rally on Wall Street on the Friday night, and that followed through this week. And on Monday morning on the ETC session, I actually discussed the prospect that if the market continues to move up, then we're going to get what's called the potential for a short squeeze. So all those people out there in the market who are short and obviously seeing, being in winning positions because the market had fallen so quickly, seeing that market move up as quickly in the opposite direction really puts the fear amongst them. And as a result, those that are short wanted to close their trade, so they have to buy to close in that instance, and that actually forces the market up higher as well. So we'll just have to wait and see what the full extent of this is, and we'll only know that in over the course of the next couple of weeks. But certainly one of those phenomenons that happens quite often in bear market territory.
That's right. So there's no way to predict with certainty. What is the market going to do? Is the rebound going to continue? But what we're going to try and do today is I'm going to look at it from my fundamental hat on, and look at some charts that tell me whether conditions really have gotten better or whether they're still pretty bad, and then you'll look at some charts from a technician's perspective and see what you think. So we'll give both of our opinions on pretty much to answer this question: the market rebound, can it be trusted? So we've had the worst start to a year in decades. I mean, this is what we've been discussing. A lot of markets have recently touched bear market territory.
And what do you mean by bear market territory?
Yeah, so bear market, typically the definition of anything falls 10%, it's considered a correction, and anything has fallen more than 20% is considered a bear market. So I know the Australian market, you might have figures coming up, but off the top of my head, I think Australia and the global index in particular both got to about 20.5 or 21% or something like that from the high to the low. So some key markets around the world technically in the last week and a half got low enough that the pullback from last year's highs is officially considered bear market. We've had this strong bounce, and as I mentioned, we're trying to establish, is this the start of a bigger rebound, or is it what we call a dead cat bounce? Just, even in a big down market, it doesn't go down every single day, every single week. You get your little pops higher, and as you mentioned, a short squeeze can sometimes see a very quick run higher. But if it's just going to run out of puff, then you need to sort of know that. So let's look at some charts. Let's kick things off. And starting off with my perspective, what I like to do is to put my finger on the pulse of global markets from a fundamental perspective is I look at the risk indices. One of the things I look at is the VIX. I look at yield curves, and I'll look at both US and Australia, and I look at credit default swaps in the US and Australia. Now, I don't want to get into a complete explanation of how these things work. Most of my members have seen these before and they've heard me talk about them. Certainly, if anyone out there, if a bunch of you would like to know more about what these are and how they work, we can look at holding a session to discuss those. But I'll assume you kind of understand the basics. But I'll just a very quick intro on each. The VIX is basically it's called the fear index. It measures how nervous or how much uncertainty is in the market. When that goes up, it means things are risky. The yield curve shows the market's expectations of interest rates in the future. And certain shapes of the curve indicate particular viewpoints. And credit default swaps, this is basically the cost of insuring against companies going bankrupt. And so if something is considered more risky, you pay a high, just like your car insurance.
Pay a high premium.
If insurance company just learnt that you just hotted up your car and you had 4 accidents in the last year, they start charging you more premiums. If you're a safe driver for a couple of years after that, they drop your premium. So it's a similar kind of theory. So starting off with the VIX, and this is over the last 12 months. I've got my rule with the VIX is that I start getting nervous on the VIX once it starts climbing above 20. And we can see it spent the first half of last year comfortably under that level. In August last year, it spiked considerably higher when we got a lot of panic around China in particular. And then it took a few months, really from August all the way to sort of end of October or mid-October for that to calm down. And actually coinciding with the VIX settling down, the market actually went a little bit higher. So the VIX moves in the opposite direction to the market. When it's high, everyone's nervous. When they're nervous, they sell. Markets go down. So that's what we've seen, obviously, a big jump in the VIX from 15 up towards the high 20s this year. In the last week, you can see that line starting to come down. It's now down to 21.6. I'd still be pretty nervous about the market while this VIX stays above 20, and I wouldn't be actively getting back into the market until it gets back down to about 15. So for me, the VIX is getting better over the last week. I'm still quite nervous. Still tells me there's plenty of uncertainty, plenty of fear, plenty of potential for downside in the markets.
Yep.
The yield curve. If I can summarise half a year of economics into about 5 seconds, when the yield curve looks like that it sort of starts on the bottom left and curves exponentially up to the top right, that's what we call a normal curve, and that signals that there is economic growth ahead. So in America, the fact that it goes from bottom left to top right is a good thing. Mm-hmm. It means the globe, the world thinks that the American market is going to strengthen over the long term.
Yep.
That rates are going to go up. Mm-hmm. But what's interesting is that the steeper the curve, the better it is. Right. The more growth the market is forecasting.
Yep.
And if you look at the green line was a few months ago, the yellow line 1 month ago, and the red line is currently. So the fact that it's the curve is dropping.
Yep.
Suggests that the market is not as bullish about American economic prospects as it was a month ago, 3 months ago.
So those on the left here, that's is that interest rates?
Yeah, look, it's essentially it's roughly speaking, it's a prediction of what interest rates are going to do, right. And that's over the long term. So that's going all the way out, sort of 30 years from now.
Yep.
So it's essentially basically saying that look, interest rates are going to go up in the US. Mm-hmm. And the reason why we think interest rates are going to go up is because we think the economy is going to get better and better, and they'll be able to put interest rates up.
Yep. And that red line, by the looks of it, suggesting that perhaps the rate of increase might be slower than
correct.
What they were thinking
and
6 months ago.
And the reason why we're now expecting lower rates than before is because the market now has a slightly more pessimistic view than it had a month ago, 3 months ago, 6 months ago. So this tells me, until I start seeing this curve going back up,
yep.
Again, I'd be still quite nervous about the market. And again, it's not that the curve is completely upside down,
yep.
but that we're still bullish about the US, not as bullish as we were. Mm-hmm. Australia is a little bit different. That sort of first part of the red line, that big dip, probably shouldn't be there. I think that's a bit of data. I tried to tweak that. Not sure why it's there, but similar kind of theory. And you can see the green line again 3 months ago, yellow 1 month ago, red line now. And this is a little bit different to the American one, because while the American one kind of goes up quite quickly and then sort of flattens out a bit, Australia actually is expected to be flat or sort of dip first. And what this is basically saying is, particularly the red line, is if you look at sort of 4 or 5 of those vertical blocks of time, exactly. That's looking out sort of 2, 3, 4 years out from now.
Right.
And you can actually see that interest rates in Australia are expected to dip over the next few years.
Okay, so when we're looking at this, we're really looking at the left-hand side of the chart, not the right-hand side.
Correct. So what these are is this is each of those blocks is 1 month, 3 months, 6 months, 1 year, 2, 3, 5, and then it kind of goes out to the longer period. So what you're saying is over time, where do we think rates are going to be? And this is saying that in the first instance, near term prospect is lower interest rates, and then eventually things are going to recover.
Yep.
So this chart, in one chart, basically says that the Australian economy is facing a pretty tough time for a few years. Then it should get better. So that's the first thing it tells me, is that there's a bit of pain before we get to the gain, and certainly a worse outlook than the US. What it also tells me is that similar to the US, the lines are getting lower. So not only do we expect that things are going to get worse, but when we're actually more pessimistic than we were a month ago, more pessimistic than a few months ago.
Gotcha.
And until that red line starts creeping back up towards where the green line was a few months ago, again, I'd still be more pessimist. My pessimism would still be there.
Sure.
I hope that isn't sort of too tricky for some of you that haven't done these things before.
Well, I sort of understood that, Jeff, so if I can understand it, then you do a good job.
Okay. What we've got here is credit default swaps. And essentially this is, like I mentioned, like an insurance, the insurance premiums for insuring against a company defaulting on its debt. And so it's 116. What this actually is essentially 116 basis points, or 1.16%. So if you had $1 million, if a company had lent you $1 million, and you were worried that they might not pay you back, you could essentially go and buy an insurance policy, which would cost you $11,600.
Yep.
And then if the company sort of defaulted, then this pays you back in a sense. So as we can see, the cost of insurance was very flat for the first 6 months of last year.
Yep.
It went up obviously in August, came back down, but we've reached new highs.
Keep going up.
So whilst the VIX, while the market in general is not as uncertain as it was last year, the chance of American companies going bust is actually higher than at any time last year. And we've seen again it pull back a little bit in the last week, that from that top into to the last price at the very right hand side, but that's still a very elevated level. So, I'd like to see this get back to, maybe somewhere around 80, 90 before I started feeling like the market had more confidence in American companies.
Yep.
The Aussie one's probably even worse. The Aussie one has basically doubled over the last 12 months, and in particular, it's just since the beginning of the year has gone up, quite a bit.
Yep.
Again, we've got that pullback towards right at the end, but I'd really like to see this come back towards sort of 100, 120.
Yep.
So this is basically saying that the market is getting, is probably 30%. They think there's about a 30% more chance of an Australian company defaulting compared to American.
Wow.
And I'm not saying that's like 1% and 31%, but it's 1.1 to 1.2 to 1.6%.
Yep.
Our Aussie companies are basically seen as riskier than American companies in terms of paying back their debt. So yeah, I'd still be quite nervous about that as well.
Yeah.
So it's quite a lot of information. So just a bit of summary. VIX, it's coming down, which is good, but it's still above 20, which is a bit of a worry. I'd really like to see that get back down to about 15. The yield curve in the US, look, is still pretty positive. It's definitely in the right shape, but it is flattening, which means it's not as bullish as it was. The yield curve in Australia has a couple of things going against it. Not only is it flattening, it's getting lower, but there is actually the prospect that things are going to get worse in Australia before they get better. The CDS index in the US is falling. And it's good, but it's still really high. So, I mean, I could probably put this is a color coded, so red is bad, green is good, orange is a bit mixed.
That was green is good, not greed.
Well, it depends. Yeah, in this case, green is good.
Yep.
Obviously, a famous financial speech there, cinematic speech. And the CDS index in Australia is also falling, but still quite high. And those last two, it wouldn't be ridiculous to put those in red either. So, look, overall, I think the general consensus, my whole argument is everything looks better now than it did a week ago, but everything still looks much worse than it did 6 months ago or 12 months ago, and is still probably in, high risk sort of territory. So, yeah, I wouldn't be jumping into the markets at the moment.
Yep. Okay.
And that's my view at the moment.
Terrific. All right. Well, we'll go through and have a bit of a focus on some of the technicals and see if there's any correlation or coincidence between what we're seeing on the charts and Jeff's view. So just wanted to go through and have a look at some key indices. Obviously the S&P 1500, the ASX 200. The Nikkei, that's the Japanese market. What's it been doing? What's it done for the course of this year? And we'll have a look at that in each of these indices. The DAX, just really representative of the European markets. The 30-year T-bills, what direction are they moving at the moment? Is there any relevance to that at this particular point, and what does the future hold? And also oil. The global index, so this is basically something that your fund managers try to outperform if they're running a managed fund of any sort. What's that telling us about the world as a whole? And also just having a look at the dollar yen. Last week we spoke about safe havens, we talked about bonds, we talked about the dollar yen as a bit of a safe haven as well, repaying US dollars and buying Japanese yen. What's that telling us about sort of fear amongst the markets at this particular point in time? So what I'll do is I'll just go through and bring up Beyond Charts and go through and have a look at these. We'll go through and have a look at the S&P 1500 to start. So what I've done here, just to give you a bit of an indication, is where have we been before, i.e. the highest part of the market over the last 12 months, to pretty much our lowest close, which was actually last week. And you can see down here in the red circle, in the US market, it was down getting close to 15%, so not in official bear market territory by any stretch of the imagination. Last week having a big rally, and those three big Marubozu candles there, really putting some heat underneath any investors that were short, scaring the socks off them. And that's now sort of pushed the market back up to only being down about 10% from its market highs. So the question really is out, where is the market going to go to from here? And obviously some of the key areas that we're thinking about are, previous points of overhead resistance. So we're thinking, on the S&P 1500 around about that 446 level, somewhere around there, to see whether or not we can close above that particular level. If we can close above that level and stay above it, then we might find that this rally's got a few more legs in it. But if into next week we start seeing some quite bearish candles, then it's suggesting that we've got a big point of supply that's much lower than the previous, and really does sort of make us think about perhaps another leg downwards. So we'll just have to wait and see at this particular point in time. The Australian market, really interesting. I've just put the moving averages on here like I did with the US market. And even just for the layperson who knows just a little bit about moving averages, we've got three moving averages here, a short, medium and long-term one, and they all crossed to the downward side back in July of last year. Now, from that particular point in time, those moving averages, it's quite noticeable, they haven't reverted back to the opposite way. So on the way up, we had red above blue above green. Once they all crossed to the downward side, we never had red, the short term, moving back above the blue, or the blue moving back above the green, any time since that particular occurrence. It's no surprise that this time last week, our market was down from its highs over the last 12 months over 20%. So officially bear market territory there, Jeff. well and truly. And certainly our moving averages are telling us, look, we're still got a long way to go for this market to go back to all-time highs. Well, not even all-time highs, but highs over the last 12 months. We're a long, long way away from that. The rally that we've had over the course of this last week, up until yesterday at least, put us back, only down around about 16.5%. Only. So certainly, I think this time around, Jeff, when people get their 6 monthly statements from their fund managers, etc., that there's going to be a fairly significant difference to the previous 6 months. And that goes for whether you're in funds that are Australian dominated or even globally dominated. So by comparison, the Japanese market, the Nikkei, as of last week, down, getting close to 30% off its highs. So this is a major market in the world, and this is certainly having a big impact, on other markets and adding up to volatility. Obviously, the yen, Jeff, you would know more about that on a fundamental perspective, but even last week with a little bit of a rally. Now this rally during this course of this week, not nearly as strong in the Nikkei as the overseas markets in the US. So whilst we have had a bounce, we're coming up to what were old support levels, now acting as resistance levels, which is really sort of critical from a technical point of view, whether we can close above these old levels or whether we start to roll down and go head further down. Jeff?
Well, I think in this case, the breakdown sort of just over a week ago, I think was more violent than the Australian and the US.
Yeah.
So whilst the Australian and the US have kind of rebounded from the previous lows, more akin to sort of a double bottom, this is actually breached again,
Yep.
and all it's doing is getting back up to the previous lows, which is further down the sort of the hole than the other markets.
It certainly is, and this is the sort of market that may well be a bit of a front runner to other markets. We'll come back and we'll have a look at a correlation with this in a moment. Just the German market as a bit of a comparison, down 30% on the year. As of last week, a little bit of a bounce this week again. We've got a doji candle there just representing some indecision, and for me that's a worrying sign, seeing that indecision at these old previous levels of what once were support. If we can't get above those levels, it's not a positive sign for the European markets. The T-bills, the 30-year US Treasury bond, if you like, perhaps behaving a little bit inverse in respect to what the overall equity markets are doing. You can see that we had this tightening formation. Really, from a technical point of view, you might call this an ascending triangle. Once broken out, you'll see that the formation really does sort of tighten towards the end, and then you get quite a quick move to the upside in this particular case. Interesting to note that from the lowest point over the last 12 months to where it price is now, these T notes are up nearly 17%, which is obviously a fairly significant move. Interesting that during the sell-off this last week, we actually came down a little bit, but really interesting. Last night's candle on this chart was really very bullish in comparison to what was exhibited on a lot of the stock charts. So sometimes, the bond market can give us a bit of an idea as to what's happening on the equity markets, as an example. So certainly well worth keeping an eye on this particular chart to see whether it does in fact hold up above these levels or whether we start moving higher, Jeff.
Yeah, and bond markets are considered to be more sophisticated than stock markets. You get all types of people trading stocks, but you don't get sort of mum and dad investors, to use the cliche, trading bond markets traditionally. So if I was looking at the bonds and stocks and they were giving off slightly different signals, I'd be paying more attention to what the bond markets are saying.
Yeah, interesting. And just oil. Oil's had a little bit of a pop last week, and overnight, over Thursday night rather, I've had a little bit of a move to the upward side. Whether or not we've bottomed out here at this particular point in time is a little bit difficult to know until afterwards, and obviously 2020 hindsight would be great to have. But certainly the fact that we've come down to these levels, we've bounced. Really, that $30 level seems to be sort of the psychological level at the moment, whether oil can hold above that. I know, Jeff, the Saudis and the Russians and a few are having talks about trying to perhaps restrict supply a little bit. I think the Iranians might even be coming to the party a little bit to say, well, look, we want to release some oil, we want to sell some oil, but I know, prices are down low at the moment, so there's still lots of talks going on, and I guess being a political a hot potato, it's going to take a fair bit of conviction across all those countries to make sure that oil doesn't go down too much further.
Yeah. We did discuss that quite a bit in last week's webinar as well.
Yep. ACWI, this is really the global index of share markets around the world, if you like, and you can see that last week we were well and truly, that was in bear market territory. Now, obviously, the biggest markets in the world are the US markets, and that's having a significant impact on this particular index. But again, just sort of bouncing back up towards these previous levels here, and again, we just need to see whether we can hold above, pretty much where we are at this point in time. If we can go further, that's a good sign for the markets. If we can't, and we zigzag a bit sideways, then I think there's still going to be some headwinds. And speaking of that, the US dollar and the Japanese yen, this is a forex pair, a currency cross. And you'll see from a technical point of view, and I might just zoom out a little bit here so we can get a bit broader perspective of why I've drawn in those green lines. This is really just sort of a support zone, if you like. And a number of ways of drawing it, but the really significant thing here for me is obviously, the short, medium, longer term trends are down. We've had fairly much a long period of, probably about 18 months thereabouts of sort of sideways movement, and we've now fallen pretty quickly to the downward side. Now that move to the downward side is very reminiscent of our move down on the Japanese index. So at this particular point in time, this pair has moved solidly to the downward side, so that means Japanese strength in comparison to US dollar weakness, if you like. The scary, or not the scary thing, I suppose the point to observe here technically is that we've tried to move back up to this previous sort of support zone, which looks as though it's acting as resistance and pushing to the downward side. Now, if that continues to push to the downward side, I suspect that that's going to add more pressure to the Japanese market, and certainly the Japanese market being probably the greatest underperformer of the year may well have ramifications for some of the other markets, Jeff.
Yeah, just an explanation between those two charts.
Yep.
There's a number of factors, but the simple way to look at it is that the Japanese stock market is dominated by exporting companies. Mm-hmm. So if you think car companies like Toyota and Nissan, and electronics firms like Sony, etc. And so if the Japanese yen goes up compared to the US dollar, it makes the Japanese yen is more expensive, mm-hmm. and it makes people buying things it makes it more expensive to buy things from Japan.
Yep.
So people say, oh, well, I don't want to buy cars from Japan, I'll buy them from the UK where prices are, where the pound is weak. So if a high currency makes your exports uncompetitive, yep. The companies start to struggle. When the companies struggle, the market goes down.
Yep.
And I think the Nikkei probably has, in my opinion, the strongest correlation between the local currency being strong and the market being weak.
Yep. So interesting, in terms of that particular market, keep an eye on the dollar yen pair over the course of the next couple of weeks in particular. All right, we might pop back into our slides there just as a bit of a wrap up. Key summary: equity indices. Well, they're bullish for this week. They're at key levels, and again, we're just going to have to wait and see what happens. I mean, they are at critical levels. It'll be important technically to see whether those levels hold. Whether there's any follow through next week. We do have options expiration in the US this week, so sometimes prices tend to remain fairly flat around those levels. Oil has it bottomed at this particular level. Can it remain above that $30 level? That's all pretty key. The T-bills, they look as though they're ready to move higher, so certainly keep your eyes on that from a technical point of view for possible indications as to, again, a little bit of a fear index type of move as well, isn't it, Jeff?
We've put that in red. The T-bills look quite bullish, so you could put that in green, but T-bills going up is generally bad for the markets.
Yeah, exactly. And technically, they actually looked a really good long setup in terms of the price action as well, which the ETC guys would appreciate. The dollar yen looking very bearish at this particular point in time, and that's likely to have an impact on Japanese markets. That's about it from both of us this week, Jeff. Hope you've enjoyed the sessions. Thank you very much to everybody who provided feedback during the course of the week. It sounds as though you're enjoying the type of presentations that we're doing for this, so we will continue to present in a similar format over the next few weeks and months. That's it from me.
And that's it from me. Have a great weekend.
Bye for now.